Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today got a couple things to talk about here. We're going to talk mostly about some of the actions that the Trump administration has been making to try to support housing. Now, if you watch my last two episodes, I was talking about our kind of estimates for what's going to happen with the 2026 housing market and interest rates. And one of the things that I said in that episode, my first episode of the year, is there was a big X factor. And that is, what attempts is President Trump going to take to try to make interest rates lower or, do things that might impact the housing market. And I think it's very reasonable to ask that. Matter of fact, right after that episode came out, or right around the same day that that episode actually aired, is when we heard from the president about the $200 billion. So we're going to talk about that for just a second. But look, let me take you back all the way to before President Trump was elected. He had mentioned during his campaigning that there was going to be attempts to help the housing market in many different ways. And I actually did a quick search on AI, just like what are all the things that the current administration has done to try to, help the housing market. And it gave me a whole list of different executive actions that have been taken, executive orders, things that we've talked about on this podcast more recently, like the 50-year mortgage idea, which we kind of debunked that whole thing, the portable mortgage idea, all these different things, right? And I'll be honest with you, I go to AI and ask that question because some of the things that it lists weren't helpful to the housing market, right? Anyway, I'm not going to get into it. I'm not going to go through them all, but there's definitely some things that I was scratching my head going, I don't see how that's helpful to housing. But there's no question that they're taking, they're throwing things against the wall and seeing if they're going to stick. Now, this most recent one, which was the $200 billion purchase of mortgage-backed securities. Now, I'm sure all of you remember that this is really just quantitative easing, right? But it's not from the Fed, right? QE comes from the Fed. This is not proposed that the Fed is going to be purchasing mortgage-backed securities because we've talked about that. And Jerome Powell has made it pretty clear in all of his Q&As that have happened, because I watch almost every one of them, that they really have no intention of purchasing mortgage-backed securities in an attempt to drive mortgage interest rates down lower, which would help affordability. There's no question about that. So it feels like Trump just kind of took it upon himself then to direct FHFA, Fannie and Freddie, to take some of their reserves and use that money to purchase mortgage-backed securities. Now, interesting enough, they've actually been purchasing mortgage-backed securities. So it's not like this is a brand new idea. They have been buying some, but certainly not at the level that he's proposing. But most people don't even know that they have been buying some mortgage-backed securities. But this $200 billion is interesting because the market really liked it. I mean, when I say the market, I mean mortgage interest rates improved pretty immediately. And they're still improving today as I record this episode on the 14th. We saw a good move in the bond market. We had some light inflation data and, some other weakness in the market, but it looks to me like we're seeing the follow through of the market digesting what this really means if Fannie and Freddie in fact, do move forward with the $200 billion of purchasing, which I think they're going to do. Why wouldn't they? They've already been doing it. They're just going to ramp it up. Now, I think this closes the door on the idea of Fannie and Freddie coming out of conservatorship and going back to being a publicly traded company, right? Because really what this is doing is this is absorbing a lot of their liquid reserves in order to do this purchase. So just know that was something that was talked about early in 2025 about that could help the housing market. Matter of fact, when I looked it up in AI, the announcement that they were going to try to take Fannie and Freddie out of conservatorship was listed as a reason, that was to support housing. I think this takes that off the table, at least for the foreseeable future, is kind of my guess. So what would this $200 billion do? Well, let's think back to the most recent quantitative easing that we had, and that was during COVID, right? Around March of 2020, I believe, is when, the Fed dropped rates immediately and started purchasing both mortgage-backed securities and treasuries. Now, that package was, at the height of it, was $120 billion a month. 40 billion of that was purchasing mortgage-backed securities, and the difference was purchasing treasuries. So we have some historical data here, but we're talking $40 billion a month for an extended period of time. This time we're talking about just $200 billion. So my first question is, well, how would that be deployed? And if you look closely at some of the comments that were made by Bill Pulte, after Trump made this announcement, which I think it was just a tweet or a message on either X or True Social or something, which seems to be the way that we get these comments these days, which is crazy to me. But nonetheless, one of the things that Pulte said in an interview was that it would be an accelerated deployment of those funds. And so I think that leans towards this being shorter term, but more money per month. So I would estimate that we're looking at 25 to 35 billion a month of purchases for an 8-month period of time. I think that would have a pretty meaningful impact on interest rates. Now, keep in mind, just like when the Fed lowers rates, we've talked about this a lot, the market starts pricing this stuff in, right? So that's happening as we speak. It's been happening since the day this announcement happened. The rates have already come down. And so this is already starting to be priced into the market. So if this doesn't come to fruition, you'll expect rates to pop back up immediately. Depending on how they actually end up executing this will dictate if the kind of futures estimates that were made now end up being reality, or if we see further improvement in rates. But my guesstimate is 25 to 35 billion of purchases, which is pretty substantial, but for a shorter period of time, like 8 months. Now, keep in mind, Jerome Powell's out in May, I believe that it is. And so, I think the thought is this gets us to that point, and then we can get a new chair, and maybe we can get some more, aggressive means of doing something with interest rates. Now, this concerns me. I mean, look, I'm in the mortgage business, so I kind of love this idea, if I'm being honest, but it concerns me because isn't the Fed supposed to be independent? Like, it sure seems like there's a lot of leaning here on influence from the Trump administration over the Fed. So that's a little scary, I'll be honest with you. But I'm just reporting the news here as I see it and my take on things. Now, let's just say that they did a more relaxed purchase. Let's just say they spread it over a 12-month period of time. If it was 12 months that they deployed that $200 billion, you'd be looking at something more like what I estimate 16, 17 billion a month in purchases. Still substantial, but less than half of what they were doing back during COVID. And keep in mind, what that did is that took rates from somewhere in the mid fives down to the low threes. So we don't expect that to happen, but we do think that this will be meaningful for rates, and we're already seeing the benefits of it. Now, there's something that's very interesting about the timing of this, in my opinion. And this, the 200 billion was announced on January 8th. And on January 9th, there was an investigation probe into Jerome Powell. Now, in fairness, that had started in late 2025, and they just sent the subpoenas and all the stuff to the Federal Reserve on January 9th. But isn't it interesting that Trump announced this purchase of MBS on the 8th, and then this thing with Jerome Powell happened on the 9th, which could be destabilizing a little bit to the market? And maybe Trump's action there was a little preemptive to stabilize the market, kind of hedge. I don't know. Seems reasonable. I couldn't find any articles that, suggested, any official articles, but I've heard that scuttlebutt in the industry, and I don't know. Seems reasonable to me. Seems like something that maybe Trump might do. But let's talk about the Jerome Powell investigation because, I think we have to. I think there's a lot of confusion around this. So really what this all boils down to, and I look, Jerome Powell's out in May, but I think the Department of Justice is looking at this saying, hey, we feel like Jerome Powell lied to Congress. So this all goes back to the June 2025 testimony in front of Congress where they were answering questions. He was answering questions specifically about the renovations and updating that they were doing to the Federal Reserve buildings. And what they're claiming is that there was misrepresentation as to the cost and the scope of that project. And so really what this is just saying, look, you lied in front of Congress, which is illegal, and we're going to start an investigation asking for documentation and things of that nature, some subpoenas to determine if in fact you intentionally misrepresented what the Fed was doing with those dollars that were allocated for this renovation. That's what this is all about. Now, you could argue that there's, that this is just part of Trump's, frustration and, with Jerome Powell, and it's kind of a witch hunt. I don't know. But that's technically what these subpoenas are all about, and it could lead to an indictment. We just don't know. But it hasn't really destabilized rates that much, and I think that's because it's overshadowed by this $200 billion, which... yeah, interesting timing. Now, a few other things that have come up. There's just talk this in the last couple days about the Trump administration suggesting that they're looking at ways for people to redirect the funds that might be in their 401k or even their college savings plan. What's that? The 529, I think it's called. I might have that wrong, but the college savings plans that people have, being able to redirect those funds without penalty towards purchasing a home. So again, more attempts to try to support and grow home ownership here. So it'll be interesting to see where that goes. I think a lot of people are reluctant. I've been doing mortgages now for almost 30 years, and you've always been able to do, withdrawals from your 401k, although sometimes there's penalties, depends on how much you take. You can take a little bit amount, and it's not a huge penalty. You could do a loan against your 401k, and you got to pay yourself back with interest, but you're not paying penalties if you do that. So there's been some access to some retirement funds over the years, and I just find people reluctant to want to do that. But maybe in today's market, if it gets them into home ownership, maybe that helps free up some liquidity that people have, and it does help the housing market. You've also heard, of course, about, the crackdown on institutional lenders purchasing, investment properties and so on and so forth. I think I've seen so many conversations about this. It's kind of been a little bit debunked that, look, yes, there was times where institutional investors were literally buying up whole neighborhoods. Like we would have a housing tract and an investor would come in, a hedge fund, and they would buy literally every house in that development, turn them into rentals. And look, I think we can all agree that's not, great for for home ownership in the United States. But at the end of the day, if you look at the numbers, there's quite a bit more homes owned by individual mom and pop, investors than there are institutional investors if we're talking about rental properties specifically. So I don't think it's as big of a thing. When it was happening, it was frustrating because it was right in the height of, a competitive market. And we got these big institutional lenders showing up and paying cash and making it very difficult for people to get into homes. But if you look at the overall portfolios and how much are owned by these institutional investors, it's not a huge thing. Now, I think one thing that has been kicked around is why don't we incent these hedge funds to sell these homes? Maybe allow them to pay less taxes or whatever when they sell these homes. There's some things they could do there that would incentivize them to release some of their holdings, creating more inventory. As we've talked about in the last couple episodes, inventories are good. They're not fully back to normal levels, but they're good. But that could change really quickly with all the attempts to lower mortgage rates. And if we see rates come down and supply gets all dried up again, you guys, we're going to see a pretty massive surge in values, which is great for homeowners, but it's not great for affordability, and it's not great for helping more people get into houses and more young people get into houses. So I'd like to see efforts made simultaneously to help continue to increase inventory availability while we work on, these solutions, some of which are crazy solutions, but solutions nonetheless that are attempting to bring down mortgage interest rates. And then lastly, you guys, I just want to touch on this comment that the Trump administration made about credit card interest rates. This one's interesting. I've seen it misrepresented a lot on social media. And just to be clear, my understanding of it is there's been no formal action taken, right? Trump has suggested and recommended that these credit card companies cap their interest rates at 10% for the next year, 1 year. This is not like a forever thing. This is not putting a moratorium on high interest rates for credit cards. This is a 1 year deal at 10% interest. Now, let me just tell you that that's a crazy percentage. Would it help a lot of people that have credit card debt? Yes, absolutely. It would help a lot of people. But is it fair to ask these banks to have completely unsecured debt, which the people barely qualify for? It's not like you're giving your W-2s and pay stubs, when you apply for a credit card, right? I mean, it's solely based on your credit score. And, so these are loosely qualified for, and they're unsecured, and they're asking them to cap them at 10%. I mean, I just think that that's a pretty low rate when you consider the risk of credit cards in general. Now, do I think that it's appropriate that people are being charged 25, 30, and sometimes over 30% interest rates on their credit cards? No. So I get it, but I think the 10% is just too low of a number. But at this point, it's really just a suggestion and maybe a little bit of a threat, because I think Trump came out and doubled down on one of his interviews and was like, they better do this, or else, whatever that means. Look, what's interesting about this proposal is it couldn't be more, it definitely has bipartisan support. This actually harkens back to a bill that Bernie Sanders was trying to get through Congress a couple of years ago that capped what the interest rates could be. That was like a 5-year proposal, I believe. So this is a little different than that. It's 1 year. But look, we're talking about Bernie Sanders and Trump both asking for the same sort of thing. You couldn't have, two more people on different end of the spectrum here. And so this does seem to have some bipartisan support, but just like that bill that Bernie Sanders supported in the past, it didn't get through Congress. So I think it's unlikely that this goes through. And I do think there could potentially be some devastating impacts if this did go through, even if it be for 1 year, because what I fear would happen is, although all these people that have outstanding mortgage or outstanding credit card debt might have their rate capped at 10% for a year, let's say, okay, that's cool. But that means the banks are going to do what they have done during other kind of liquidity crunches that we've seen, where they just slash people's available credit limits on their credit cards, or just close their cards altogether. Say, we have to deactivate these cards. You still owe us the money. It'll be at 10%, but no, we're closing the credit card. They don't have to offer credit to everybody. And that would impact people with more medium to lower credit scores, right? I mean, if they're going to lend money to anybody, they would do it for the people of the highest credit score. So it would remove access to credit to, I think, a huge segment of the population, because the banks would just change their policies. They would just issue less credit cards. But then think about the impact to consumer spending. I think it could be devastating to consumer spending because people are relying on, their credit cards to purchase goods, and that definitely helps the economy. And now we can argue, I'm not here to debate whether or not it's a good thing that people, some people might say, well, good, like shut off their credit cards. They shouldn't be spending money on credit cards anyway. Okay, fair enough. That's not what I'm talking about here. I'm not here to police how someone manages their own personal budget. I have my opinion about it. That's not the point. The point is the impact to the actual retail sales numbers and what that would do to GDP and what that would do to our economy could be pretty devastating. And I don't think people have fully thought that through. So I don't know, this whole 10% interest rate thing for the people that have debt, kind of cool. You get a little reprieve for a year. I just don't see it actually getting through Congress. I don't know that Trump could do this through an executive action. Who knows? I mean, he seems to do a lot. I mean, it's not just Trump. Every president takes tons of liberty with these executive orders these days, it seems like. But I don't know if that could even happen. I think there's a massive lobbying effort. I mean, the bankers and the credit card companies, they have huge lobbyists. The likelihood of this getting actually approved, I think, is pretty slim. I also think there'd be pretty significant repercussions if it did. Could be kind of cool for people that, have outstanding credit card debt. Maybe they could get caught up. Maybe they could change their relationship with how they manage their debt. But if you look at all those different pieces, I think there's a lot of danger in that deal. I mean, maybe there's something we can do, but 10% just seems low. I mean, I work in real estate investing. If you're trying to get a hard money loan, which is secured by a piece of real estate, even those rates are 10 to 12%. And it's secured by a piece of real estate, Second mortgages are secured partly by homes, in theory, if values don't drop. And those interest rates are, 9% or so. So, I don't know. Completely unsecured debt at 10% just doesn't seems great for the people, but it just doesn't seem reasonable. It doesn't seem like reasonable to the banks. Anyway, I'll quit belaboring that point. I think you get where I stand, but it's an interesting thing to keep an eye on. And like everything, there's ripple effects. There's unintended consequences. And I think all of these things that are being proposed, in some way or another, they potentially have unintended consequences. Even the purchasing of mortgage-backed securities. When do you think interest rates went up into the 7s? Oh, weird. It was when the Fed stopped buying mortgage-backed securities in 2022 and rates shot up. So, do we give really cheap money for a short period of time and create some additional inventory by putting pressure on institutional investors? Or maybe if we don't do that and home prices go up and then all of a sudden rates turn right back around and jump back up and now we're in a worse spot than we were. Those are the things we got to think about. We got to think long term. But it's all very interesting, and it gives me great content to talk about here on Market Shares. I hope you enjoyed this episode. Keep an eye on all this stuff because it's going to be an interesting year in 2026, and I think we're going to have some wins through all these different efforts. I do believe they are going to have material impacts on rates. We're seeing it already, and that's going to be opportunities for people to refinance. It's going to bring people, when rates get into the low 6s, or even high 5s, that brings people into the market. It just does. We've seen it over and over and over again. So if you're in real estate, if you're in mortgage, be ready to capitalize on these opportunities. It's going to be volatile. They may be fleeting, but it's going to be a fun ride. So stick around. If you want to see our episodes here of Market Shares, we release a new one every single Friday at 10 a.m. Pacific time. So please subscribe to the channel to make sure you see them. And let's see how this goes. We'll give you updates as we roll along. Until next time, take care.